more, better, new. Just do way more of something until you've squeezed like every last dollar out of that revenue stream. Yeah. Then go back and make it way better and get your conversion rates up and get your closing rates down. And hopefully we're closing 1 out of every 3 off-market properties or whatever. So more, better. And then when you've maximized every ounce of juice that you've squeezed out of that orange, then you can even consider something new. Versus before it was like new, little more, maybe better. We're just all over the board. So more, better, new has like really been huge for us.
Hey, Colorado, Chris Lopez, the host of the Denver Real Estate Investing Podcast. I have a great guest in the studio today to come talk state of the market when it comes to flipping properties around Denver, Colorado. We're going to talk what's happening in the market, like trends. We're going to talk some deals, talk a little shop. This name is familiar to many people on the podcast. It's Derek Marlin with Elevation. Derek, long time, man. It's been too long.
I know, Chris. It's fun to be back in the studio. Thanks for having me, man.
Yeah, we're going to try and make this a more regular thing. We had a good cadence there for a while, and then interest rates went up and life got busy.
Yes.
But just quick refresher for people who don't know who you are in Elevation. Quick background about you and what Elevation does, because you have a really cool model.
Yeah, no, I appreciate it. The long story short is 2 or 3 long corporate stints in professional sports and sports media, and then got into investing in 2009. And then a lot of people either say congrats or they like cringe. And I got lucky because I was buying rentals in 2009. So did rentals for quite a while and then went full time. And it's kind of crazy. We just celebrated our 10-year anniversary at Elevation. So started in 2015. And our current model now is we like to call it property redevelopment, because I don't love the term flipping, but nobody can find that from an SEO perspective. So flipping it is. So we flip properties. We also have a transparent wholesaling division, and we can talk about why we call it that later, but we do wholesale properties to our clientele. And then we have a consulting division. So we also do projects and run projects for clients. So we've got some high net worth folks that want no part of being part of the process, and we do everything for them. Or we have education clients that they want to learn, and so we do it side by side. And then we still have our education division. So we teach people how to flip through the Elevation Academy, and kind of bookend that with our podcast, Raising the Flipping Bar. And then the last is our investment brokerage division. So we have a brokerage team at EXP, and we've got some rock star agents that run our investment business, including our institutional and hedge fund business. So we're still active with the hedge funds 4 years later. And so that's kind of like our summary of what we've got going on.
I forgot. I want to pick your brain on that later in the episode.
Yeah.
See what the big guys are doing now.
Sure.
All right, but let's. I want to hear. I'm really focused right now. The market's obviously been changing.
Right.
It has changed. We're recording this about 2 or 3 weeks after the September interest rate cut of 25 bips that the Fed did, just for context on here. But talk to us about where the flipping market has been in 2025 and where you see it going in 2026.
Yeah, absolutely. So I think 25 has been a continuation of 24, which is challenging projects. I think anybody that says that everything is going great, I don't know if they're telling the truth. And I think
it's not possible in real estate right now.
Yeah, shocker. They're not disclosing all the information. But that is kind of like, honestly, one of our calling cards. When things suck, we're going to tell you it sucks. And I'm calling this like a tale of 2 markets, meaning either stuff goes, really, really well and to plan, or it goes to hell in a handbasket, so it's really, really about getting the appropriate deals. It's about underwriting properly. And it's a hard thing for people to consider, but underwriting so that the property that you're selling once it's fixed up could very well be lower than sold comps because of this crazy explosion in active inventory that's happened over the last year. So I think that's something that we didn't foresee. We thought there'd be more houses for sale, but there's a lot more houses for sale.
So there's more inventory than you're expecting.
Correct.
Yeah.
A lot more. And it happened really, really fast. I think from, March of 25 through like July of 25, we added like 8,000 homes. I felt like overnight. So then when you went to list, you might have a 10 out of 10 beautiful property, and you used to be only maybe 1 or 2 of the nicest out there. Now you're one of 5 or 6. Then there's also a bunch, what we call in the middle, like sixes and sevens and eights out of 10 that they're a little less expensive, but there's more inventory. And then you got the beaters that we're trying to buy. So yeah, I think the inventory was kind of a crazy thing, and it made it to where you got to like sharpen your sword a lot this year.
When you say tailored to cities, are you talking about kind of mostly like the final sales price? Because I mean, a lot of times it's, hey, if a property is listed well in the right location, hey, multiple showings, under contract by day 4 of listing, or hey, list Thursday, Sunday, Monday's under contract. Otherwise, it's 69 days out. Are you talking about like that aspect, or is there like contracts or other stuff in between as well?
Yeah, that's a good clarification point. No, I would say that if the property is done really well, you don't get trapped in that description that I just outlined of lots of choices in that price point range, and you price it effectively, then yeah, you're going to sell in 1 to 2 weeks. You're not going crazy over asking. Sometimes there might be a mini bidding war, which means at asking a couple bucks more, you can really kind of arm wrestle them to not give in on concessions. Or if there's any little thing that's not perfect, people just take this massive kind of discount approach, and you kind of get your ass kicked. And so something we were talking about off camera is I personally, as a company, went into, I thought, okay, let's be defensive. Let's still be aggressive as, working hard, but let's not go up the food chain on expensive price points. So just super quick context for your audience. Our normal bread and butter flip kind of price range was selling properties for between $700,000 and $900,000
Yep.
when it's fixed up. Just kind of like slightly above median home price, but super nice properties. We didn't do a lot of cheap stuff over the last 18 months. We did a couple that were over $1 million, from like $1 million to $1.3 million in 24, and those two didn't go very well. So I was like, for the time and the risk, let's just go back to hitting a lot of singles. And I did the singles, meaning we just got done selling 2 properties that were, one was in the middle, one was like a $775 list price. Could be a whole different episode. But essentially it took forever because the city put a red tag on our property, which means stop.
Was that the Englewood property?
Yes,
okay.
The Englewood one. So stop work. So just kind of crazy. Fast forward to selling it at $695. So $775 to $695, big swing. And then we had another one right down the road in Englewood where it was we listed it at $500, and just a cute little 4-bed, 1-bath starter home. I thought, okay, for 1 week, if you listed at $500, you're obviously going to technically catch people searching from $500 and above.
Yep.
But I said, if we don't get great traction, immediately cut the price. So after a week, we got a couple showings, no offers. We went to $475, got good activity, but no offers. And then 30 days later, I'm like, screw it, cut the price again, $450, and we just went under contract at $443. So those singles that I thought hit lots of quick singles was not the best, and we can talk about it later in the episode, but our clients that we wholesaled to of beautiful, more expensive properties, they're doing really, really
like
well.
$1 million plus?
Yeah, like 1.1 million all the way up to, we're listing a property for a client in Boulder Country Club next week that'll be a $2.3 million listing. And there's just monster spread in there, so there's almost just this room for error because there's such good deals, and those people are less affected than the first-time home buyer to rate sensitivity and job loss and all that stuff. So like Tale of Two Cities, it's just been kind of 2 weird flips. It goes well, and the $1 million ones went good, and my cheap singles didn't. They were okay, but nothing to write home about.
So for that property, so under contract around 440, 450. I mean, at any point does like the potential to burr, buy,
Yes.
Rehab, rent, refinance, repeat,
Yes.
Are those numbers anywhere close to coming back to make sense with like, hey, just hold on to it and rent it?
Yes. Yeah, we were probably in my, super quick underwriting without having my laptop in front of me. Yeah, we were $25,000 away from saying, screw it, we'll keep it.
So if you had to drop them to $25,000, you would just kept it for
Yes.
a year or two?
Yeah, because we were still into it for a good price. We bought it for $374. We had originally a super cheap rehab budget because it was small property and in fairly actually okay shape, just kind of weird layout. So we had a $36,000 rehab budget.
So mostly cosmetic?
Mostly cosmetic. We found a couple things. We were like, where's this weird little leak coming from? And we found out that they had changed the layout around and put wooden steps going in the front door over 2 small basement windows. And we were like, oh, that's weird. So we ripped that off, fixed it, poured concrete. So we ended up spending about $43,000. So not crazy. So, our break even was in the low 400s. And I was like, we could rent this thing all day for probably $2,750, $2,800, maybe a little bit more, and then just hold on to it for a couple of years. But that's not my personal business model from a rental perspective. So I was like,
And you would have cash flow, what, $100, $200?
A couple $100 a month.
And you would have, I'm assuming you had hard money debt on there?
We did have hard money debt.
So you would have to refi it into a long-term debt?
Yes.
Okay.
Yes. But yeah, to your point, I was like, you know what? No, I think within around that 425 mark, you back out commissions and closing costs. I'm like, why should I lose on this one? So we did, we made a couple bucks, but like nothing great. But yeah, Burr would have worked, honestly, on this one. But Burr wouldn't have worked on the $700,000 house.
Yeah, that price point's too high.
Yeah.
So I'm total side tangent here because I know I think rentals were part of your previous investing career mostly. Mm-hmm. Even making cash flowing $100, $200, $300 on paper, which we all know that can swing.
Yeah.
Is even that marginal cash flow, is that worth like the bandwidth and the headache to even like say, hey, cool, I'll maintain it. Mm-hmm. Probably break even over the year with rental and then maybe sell it in a year or two once the market turns. Or does that mental bandwidth factor into like your, hey, keep this or not?
Not for me, because I think that quickly turns into, even though you're mostly renovating the property, so you shouldn't have a lot of CapEx expenses, meaning, putting 10 grand into it for a roof or putting 20 grand into it for HVAC systems or whatever. It's just kind of our personal investment thesis and where we're at in our career. If you asked me 15 years ago when I was just getting started, if I could just grab maybe a property a year and you fast forward down the line and you've got 5 to 10, yeah, that probably is a good model. We did that, and that's how I cut my teeth, was buying all these rentals in 2009 and 2010. And then we did multifamily and we sold that off. Right now, you've been in our building. We own boutique co-workspace. And I love that from a rental perspective because I don't have the brain damage of tenants and toilets. And it's kind of, gone up the food chain, if you will. But I think if you were a person that was in their, 30s looking to build out long-term wealth, that's probably worth it. But I think you almost have to commit to the long game. Having 1 or 2 properties where you're making $100 or $200 a month, I think that's the purgatory. I think you have to get to that like 5 and above, play the long game, pay some stuff off. Obviously you're an appreciation guy. Like, yeah, that pencils down the line, but like
also the appreciation
1 or 2 doesn't
over
make
for
sense.
A while.
And I agree. We're going to be super flat, if not down, if people overpay on that. So again, it's got to be a longer timeline. So for us, it just didn't make sense to do that. I am keeping one of my properties, my crazy Fox Street property that we were in that huge lawsuit forever about. But it's because it's right near where they just announced the new Broncos Stadium is going to be. So there's like an underlying factor of why we're going to keep that one. But beyond that, we're not keeping individual
So you'll
rentals.
keep that for a few years and then sell it once that neighbor's kind of popped? Is that the...
Yes.
Okay.
Totally.
Yeah.
Yep. And we tried to sell it and get all of our money back. And it was the same kind of numbers where I was like, we're going to take a loss after having this just horrific experience where we bought it now almost 4 years ago. And it took 3.5 years of lawsuits and title companies finally having to pay out this degenerate guy that just claimed clout on title. It was the brother, and he lost in court. He had free lawyers. Again, very different podcast episode. And it's in the Baker neighborhood, and cool little house. But we ended up saying, you know what, screw it. Let's just keep this property. We finally got it free and clear. The title company had to pay him to essentially leave, rather than him appealing because he had free lawyers. And I was looking at 5 years of paying for this property on our business line of credit. So it wasn't cash, it wasn't free. And so again, I tried to sell it, but I'm like, I don't want to realize a 6-figure loss. And he trashed it, of course. So let's renovate it. It'll be a really cool little rental. We will actually probably break even, maybe make a couple bucks, and then let all the stadium stuff happen. And then just like a personal parallel to when my kids are going to college or getting out of college, like we're going to call that the college house. Like at some point we'll either keep it, or 5 years from now we'll sell it off and pay off 1 year's worth of college for a kiddo or something like that.
I like it.
But beyond that, yeah, no more individual rentals.
Okay. So going back to flipping here, so you're seeing a lot in the market in the higher end, higher $1 million plus, and I've had other flippers kind of say the same thing. The more luxury, that market's still a lot more liquid.
Yes.
So what about right now? So like we're going into what we just started Q4. So challenging time to sell. Well, historically challenging time to sell on top of what's been challenging this year as well. Kind of what's on your books right now to sell, and are you in acquisition mode to pick some stuff up to sell in springtime? Kind of what's your Q4, Q1, Q2 type plan and pipeline?
Yeah, super good question. That has been the blessing and the curse, is that some of these properties have taken a while to sell, but luckily we've sold through everything. We have our last internal closing of deals that we own as Elevation as a company on mid-October. So then we'll be out of all of our projects. Almost all of our clients will be out of our project except this beautiful house in Boulder Country Club that we have coming up. So knock on wood, obviously, I think that'll go well for these guys, because it is truly like, we're calling it the one of one property, meaning great location, great layout, cul-de-sac, or this one, you're in Boulder Country Club, just like every bell and whistle you could ever imagine. Those are still moving. And then this is ideally the best time to buy. Q4, we're seeing stuff is 100% on sale, whether it's off market, which is the majority of how we get our deals, but even on market, there's 10, 11,000 single family homes. And at some point, somebody's got to sell. And so if we can buy properties now, we can let them live in them for a month or two, get through the holidays, fix them up, and then list them March through June. That is the absolute sweet spot. So kind of buying now, loading up as much as we can handle, both financially and mentally, sell off. And then something that I kind of worked on with my business consultant is I try to jam as much business in every quarter as possible, even being strategic and smart of knowing like, hey, I can't sell a house for as much in September as I can in April, but can I still pencil in the numbers to work? And they've been okay, but we just, after now 3 years of kind of the current market environment, we're really just going to go hot and heavy in Q4, Q1, and early Q2, do as much as we can. And then whether we consult or have our margins come down to wholesale to our clients and keep everybody busy, and then load back up instead of just this like slow and steady up into the right trend.
Your personal flippings would be a little more seasonal.
Yes, a little more seasonal.
So I want to jump back to your plan here, because springtime, you said that, February, March to, May timeframe is usually the sweet time to sell. Yep. In 2025, that was not a sweet time to sell.
Right.
It was like the first spring is like, where did spring go? Or at least when I've been out here. Are you worried about the 2026 spring being as flat, or are you just adjusting, hey, buy right, very conservative on the ARVs? Like, how are you mitigating that risk factor?
Yeah, I totally agree. We are looking at it in again, a very defensive strategy. So we're underwriting the deal that the ARV or the after repair value of what we sell it for will be absolutely flat. Maybe it'll be even a little bit down, and then hopefully we're pleasantly surprised, but no, we are projecting absolutely no kind of increase. And you have to, I think if you again make that your product, if we use a scale of 1 to 10, the 6, 7, 8, kind of like that minor cosmetic, nice kitchen, but there's still some weird things. People aren't touching those. You have to either buy it super, super cheap and you're wholesaling it to your clientele, or have it as a 10 out of 10 and have no appreciation, no upside, no nothing, just super conservative. That's kind of what we're looking for.
Okay.
And if we're wrong, then it's wrong to the good, not wrong to the bad.
That makes sense. Something we were talking about before it record was just we both been surprised at the lack of lowball offers out there. Or you're talking about some of your listings, and just we talk to agents and investors and home buyers in general. Like, it's like, dude, don't be shy about putting a bunch of lowball offers in. I'm curious, as we kind of go to your acquisition strategy, 2 questions on here, like kind of like what percent is kind of coming from off market versus MLS on market, and then how disrespectful are you getting in your offers on the on market, right? And kind of what's your 10 disrespectful offers equals the contract, kind of what your ratio is there. Start with the on market, like what percent in your ratio, then shift to off market.
Yeah, and I'll kind of try to give a little context. Our on market is very seasonal for when we're writing offers. And it's been this way for the last 2 years. And we're gearing up with our internal investor or agent investor team so that we're going to be writing more on market offers in Q4, because there's just, to my point earlier, there's a lot of houses for
best time to buy.
It's absolutely the best time to buy. And people need to do something, whether it's the sellers actually needing to move, whether it's an agent needing to get in a commission and pay for Christmas presents, or like stuff needs to happen. I still think I talked to another really smart investor, and he had a cool term, and he called it fake sellers, meaning the people that are pricing it as if it was 2021 or 2022, they don't really need to sell. They're just trying to think about it. They don't, in my opinion, have an agent that has a backbone because they're wasting all their time to say, why would you sell an overpriced house? Like, you're just wasting your time, your money. Yeah. It's stupid. So like, again, I don't know, can we clear out of those people? But to your point of like, no, what used to be quote unquote insulting or lowball, absolutely. If the house needs work too, I mean, yeah, for us to write an offer $100,000 below asking, $150K, we don't care. We will 100% write it. And you can say, or people can tell me to F off and my agents to F off, but like, let's get the conversation started. And, God forbid you counter. Like, it's such a weird thing. Like, people don't even counter nowadays. It's just, I don't know. And again, I go back to my experience when I worked in finance and I was in the municipal bond market. That's all you did is just negotiate back and forth in selling bonds. And then when they sold, you called afterwards and you said, hey, can I get the cover? Which meant like, where did they actually trade? And was I way off? Did I miss it by a smidge? Like, none of that happens, which is weird because transactional volume is down. So like, sorry, I'm like beefing, but like, what are people doing? Like, I don't know what they're doing. So long story short, yeah, we are writing offers down $100,000, down $150,000. And then like, let's get close.
So these are down like 10, 20% off list price?
Correct. Yeah. 10, 20% off of list price because we're listing our flips and our last batch. Again, we'll go back to that one in Englewood, super cool house that was listed at $775. And we ended up selling it at $695, completely fixed up. So that's your 12% kind of adjustment that we saw from February to when we just closed it last month. So like, yeah, why not? Or had somebody come out of the gate, I'm listing it at $775, and most investors would probably say, oh my God, $725, there's no way I'll sell. I probably would have sold it. I would have been 30 grand better off and 4 months later. So no, I say submit it. We're submitting it. A lot more on-market opportunities now. And then we as a company still kind of push about 70% of our deals are off-market sourced.
Okay.
And that's 24/7, but a little more on-market in Q4.
Okay. So overall, you're about 70% off-market, 30% on.
Correct.
With a lot of the on being heavy Q4.
Correct.
Okay.
Yep.
Now, how you may not know this, or maybe you can look at last Q4, like how many offers did you write to go under contract on market? Did you write to go under contract to close?
We were probably only going under contract on 10 to 12% of the offers that we would write.
Okay, so 1 out of 10, 1 out of 8 offers. Okay.
Yes. Which
pretty good ratio though for lowball offers.
Yeah, it's not bad at all.
I thought it'd be like 1 out of 20.
No, it's really not that. Now, granted, with that, it was our agents being really smart and strategic of only offering on properties that, needed a lot of work, had been on the market, maybe had multiple agent changes or obviously multiple price cuts. Yeah.
So they were making smart lowball offers.
Smart lowball offers. Yeah, we're not taking like this really nice 7 out of 10 that really only needed cosmetic and making lowball. I don't think that was going to work. But yeah, our kind of the classic investor type of properties, we're like 1 out of 10, 1 out of 8. Mm-hmm.
This episode is brought to you by Dynamo Capital, a new hard money lender here in Denver. So one of the unique aspects about their loans is that they can offer up to 100% loan to cost financing. Now, let that sink in because 100% LTC means you can bring less cash to the deals you're doing, which helps you scale your business. So if you want more details, then email Caitlin at dynamocapital.com. Thank you. So before we move on to the off-market stats, Derek and I are friends. We have coffee every once in a while too, but we were just talking business stuff, and I want to give you a chance to shout because I think you're looking for a new acquisitions manager.
Oh yeah, thank you.
Give the plug for that because this is the part of the conversation, right?
Yeah. So I think something that hopefully your folks take away from this too is just like keeping your business model very direct but also nimble. And so we have a new acquisitions opportunity, meaning we've got a division that's investor focused agents of people that are finding flips, selling flips, doing some rental business, working with our clientele, kind of very diverse base. But then we have our what we call the flip and wholesale division. And so to your point earlier of like, how are we finding deals? We've now hit year 3 of working with the cold calling company that's gone really well. They've
for
refined
the off-market stuff.
For the off-market stuff. So I'm like, I finally feel like I've got the right vendor that I can turn that dial and just turn up the lead gen system. And then the mistake I made was I had a really great salesperson in this role before, but he was able to kind of execute on 6 different types of business. And no newsflash there. Like, you did really well and made a lot of money, but like the company didn't move the needle as much as I want. So now what we're hiring for, like literally this second, so thank you if anybody listens to this, it's just a phenomenal rock star acquisitions person. All they will do is hunt down deals, and they will walk in day one and they will have a cold calling list. Well, actually technically a warm list of 100 leads every month that are being dropped into our CRM that they have to call on. And as long as I can convert some business, I want to double that to 200 leads per month for this one person. And then they'll have this cool kind of hybrid model of, I get it, some people have to pay the bills, as we all do. So they'll have a base so they can have some consistent money coming in and pay that base level of bills. They'll get higher commissions than anybody else that I'm aware of from a wholesale perspective of doing acquisitions. They'll get quarterly bonuses, and then they'll get referral fees so that if they go on an appointment, the house isn't trashed, it would be a great listing, or we've got a cool, fix and list product where it's like, hey, we'll help you, put 20 grand of work into your house and list it through a project manager. They'll earn referral fees on that, or if Elevation buys it and sells it, it goes over to the other team, but they get a referral fee. So it's like, nice. I want person to make 5 buckets of income and be literally a one of one, versus some of the other wholesalers, like you're one of 10 and good luck, and you got to kill yourself to make $2,000 a deal. That's not it. And we just want, again, phenomenal acquisitions person. They'll work with the dispositions person to sell the deals to our clients or sell it to us if we're buying. Report directly to me and onward and upward. Cool. So this person should make over 250K in a year, or else we've done something horribly wrong.
Nice. Well, I'm sure some agents will be intrigued by that.
Yeah,
so they just email you for that?
Yeah, totally. They can just email me directly, just my email, which is Derek@elevationinvest.com, and you guys can drop it in the show notes, but just my name, Derek@elevationinvest.com.
Awesome. I would recommend, if anyone has interest, reach out to Derek. He and I have swapped a lot of stories and people and deals and stuff over the years, so worth the conversation.
Thank you. Yeah, thanks.
All right, so going back to off-market stuff.
Yeah.
About 70% of your deal flow, 365 days a year is coming from the off market. Mm-hmm. It sounds like you have, the way you're getting as you have a vendor just cold calling,
correct.
Motivated buyers, or motivated sellers.
Sellers, yep.
Yeah. Talk high level about, the process and then the type of deals you're seeing. Mm-hmm. And if you can compare like amount of offers and the price you get a house at compared to like the on market stuff.
Ooh, those are good numbers. So it's taking roughly 20 to 30 inbound leads to convert to one deal right now.
That's a good ratio.
So it is a pretty good ratio. So they are fairly, again...
For a third-party company generating any leads, if you're getting 20 or 30 to one closed deal, I haven't done flipping. I've done other ones. I would take that ratio.
And it started higher, and it was higher because this company was actually, I found out kind of after the fact, was outsourcing their cold calling overseas, which I knew that part of it, but they didn't. I think they were running it with another party. So technically it's like a fourth party person. They kind of just blew it up and said, let's truly take it all in-house. So now they have overseas operations in Egypt instead of the Philippines. And so better English speaking folks, they've got boots on the ground managers running truly their call centers in Egypt, and we just get better lead flow. And then what they've done, and I really kind of value the way that they're running it, is they've also then paired a coach with their clientele. They'd rather have less clients spending more money and getting more leads than lots of clients doing their base level package. Yes.
I agree with that business.
Not rocket science, but like a good model. And so now it's like, okay, so then those leads have gone from probably 40 to 50 inbound cold lead or warm leads to us to 20 to 30. And then we're really lucky because we have multiple exit strategies. So again, we can buy it ourselves and flip it.
Oh yeah.
We can wholesale it. We can list it. We can partner with the seller. So our close ratio is going up a lot more and a lot more quickly.
Yeah, more ways to monetize it.
More ways to monetize. Yeah. And it's kind of all in-house instead of just referring out. They've got clients in other markets where kind of solopreneur, all they can do is wholesale. And then they maybe, if they want to, can refer it to an agent, but they just go, ooh, it's just to our next division. So that's been helpful for us. Versus on market, we're probably about the same. We're probably, again, I'm trying to think of like seasonally adjusted. No, we were like 8 to 10 properties to go under contract. And then of that, we were closing probably half of those
Okay.
No, I take that back. Let me think through that. No, we were closing more than that. We're probably closing about 3/4 of them, because a metric that I always really lean back to when we were doing hedge fund business, a ton of hedge fund business, is I never wanted to be worse on a termination rate than the industry average. So, and I'm kind of bouncing all over the place, but from a hedge fund perspective, we would write offers in 2021 and 2022 when we were sourcing rentals for our hedge fund clients, and people would say, "Oh, screw you! You're just representing a hedge fund. You're gonna bail." And I was like, "No, we actually close more than the industry average." So that's always just been something that stuck with me. So same thing now when my people are writing offers, it's like, no, on average, if 30% of deals are falling out for just the general population, we just need to be better than that, and that's been pretty good for us.
That's a good benchmark.
Yeah.
So as far as like prices, hey, they're both good ponds to fish from, on and off market.
Yep.
Do you have better margins? Are you buying at a better basis on off or on, or is it the same, better, or worse?
Yeah, it's funny you say that, because I'm like pausing, because we're obviously recording in your studio right down the road from the Your Castle folks, and I used to teach classes with Lon Wells. Shout out to Lon, super smart guy. And he had a stat where he said there's not a lot of difference between the margin that you get as an end investor and buyer, whether you are buying from a wholesaler versus whether you're buying on the market with the appropriate discount. And I think that was probably held true while we were teaching, but I would say over the last 2 years, we definitely get better margins from off-market opportunities. Okay. 100%. And I think it's a factor of two. One, it's that we're better negotiators. We're going direct to the seller instead of having a real estate agent or multiple agents, kind of be in the middle.
Saving a few points in commission?
We're saving a few points in commission. And I think it's just getting directly to the decision maker, honestly,
okay,
is a big thing. And I think the last reason why we get better margins is one of our company missions and philosophies is to be creative problem solvers. Mm-hmm. And so the price is not usually number one on a seller's list. They've got 3 or 4 other things going on that if we can help them solve these crazy life problems, or maybe where to reinvest on the back end or whatever, they're like, oh, okay, this price is not a big deal. So we can buy at a deeper discount because we help them place mom into an assisted living and run the estate sale, or have my teenage kids move all their crap out of their house and do a garage sale. Like, if you can figure out their problems, you'll get a better deal. On market, none of that exists. It's just agent to agent, and it kind of is what it is.
That's a great point, man. As always, you're very solutions focused. Mm-hmm. Hey, what's your problem? Help you figure out a solution, which is great for real estate, great for business. But that is a great reminder for everyone out there.
Thanks.
Something else I want to chat with you about. Again, we were chatting before this. Mm-hmm. You were talking about how you as a company's Elevation, you've really just focused the last year or two. Hey, you were doing more things. You cut it. You focused more. Can you kind of share what you have focused on? What have you cut in terms of like what you're doing from a business and investing standpoint?
Yeah, it's something that it's my cheesy joke, but like I've paid my business consultant Doug a lot of money over 5 years to like teach me how to say no and teach me to try to get out of shiny object syndrome. It's
probably money well spent.
It is money well spent. Like, it's not perfect by any means. And honestly, I think it's like a blessing and a curse. And I'm sure a lot of your people listening are this way, where I look at almost everything as an opportunity, because I'm like, screw it. I can make it work through hopefully thought or hard work or perseverance. Like, that was dumb, honestly. I should have said no to a lot more stuff like coming around, and especially when you're in growth mode too. So I actually recorded an episode yesterday of my podcast, Raising the Flipping Bar, and it was like 7 ways that you can, monetize real estate right now and real estate investing. And I looked through that and I came to the end and I was like, I've actually done all these, but that's not a badge of honor, getting just really down to the nitty gritty. So for us, it's really just a function of, we want to flip properties. I feel like a just very, very complementary piece of business is obviously wholesaling. So when we're full, we then sell to our clients in a transparent wholesaling model. And the reason that is because people know exactly how much we make, and I do a roof inspection and a sewer scope on every property. So if you're mad at me that I'm making a $50K assignment fee, but I'm still delivering you a phenomenal deal, I'm sorry, but I'll sell to the next guy.
Yes, I'm also buying.
But people, we found out they got more pissed off and they're like, did you know how much they made? Let's just, I'll pull up my skirt and you can see exactly what's going on. Sorry for being crude, but like, you know exactly what's going on.
Also, shocking, people make profit doing this stuff.
Yeah, and nobody sees that I've spent tens of thousands of dollars every month for who knows how long to get like the deal, but I digress. So flipping.
You can show your scars if you want to, Derek, right?
Yeah,
like that's what happens. People don't realize.
That's true. You're right. I got to have my scars covered up, my emotional and my physical scars. But flipping, wholesaling, and then for us, again, it's just been a really nice complementary piece of business is the consulting aspect. So we then consult for people, meaning they're essentially fronting the money for the deal. We many times have found the property for them. My project management crew runs everything. They tap into our vendors, our network, our contractors, get the best pricing, and then my agents give them a discount and sell it on the back end. So it's not super shiny, where before I had done apartment syndications and individual investing. And, again, we do a little bit of education through our academy, but we've really just narrowed it to 3 super, super close things. And then try to say no to as much other things as possible. So to your point earlier, like not individual rentals, not burst strategy, not traditional real estate. All of our agents on our EXP team focus on investments first. Again, like don't turn your mom down if you want to sell her house, but you're not out prospecting, trying to grow that piece of business. Ironically, it organically comes back to you. So like just narrowing, and I'd leave your audience with like another kind of philosophy that I've been really trying to do. And I got this from another coaching program, and it's called More, Better, New. And so super simply, it's just do way more of something until you've squeezed like every last dollar out of that revenue stream. Yeah. And it should easily be at least 7 figures, maybe 8 figures for some people. Then go back and make it way better and get your conversion rates up and get your closing rates down. And hopefully we're closing 1 out of every 3 off-market properties or whatever. So more, better. And then when you've maximized every, ounce of juice that you've squeezed out of that orange, then you can even consider something new. Versus before it was like new, little more, maybe better. We're just all over the board. So more, better, new has like really been huge for us.
I like that. And I agree with that philosophy there. I was actually just writing my 2026 investing chapter.
Oh, nice.
And I was talking about, I call it like stacking, just like you're stacking a lot of like your synergies and operations. Like, hey, if you're leveraging your current contractors and SOPs and staff you have on salary to go out there and say, hey, consulting client, you can use this. Like it's a much more alignment. Things are stacked that way where it's good for you, good for systems, good for the client versus like, oh, here's a totally unrelated thing. Yeah. Right. So you're stacking on top of it. So I love that model. All right, I got one more thing I definitely want to pick your brain on. Yeah. And I'm glad you mentioned this in the beginning is working with hedge funds.
Yes.
Because I know you have some, Wall Street background and then you got into real estate. So I'd love to kind of refresh you on kind of what you've done, throughout the market cycle. Okay. And I really want to know what hedge funds are doing now because I've talked to a few different, people and companies around town that work with them.
Yep.
And man, it's a wide variety of what things are going on right now.
Yeah, so I'll give the audience just a quick little bit of backstory. So I come from a Wall Street family. I'm originally from the East Coast and born and semi-raised until I moved to Denver, but in New Jersey. My dad physically and literally worked on Wall Street. My grandfather worked on Wall Street. Tons of people in the Marlin family worked on Wall Street, but mostly on the bond side of things. So not a stockbroker or equity trader on the debt side. So then I did that myself with my dad for a couple of years, got my Series 7, 63, did all that. Got super bored, but that made me a way better investor. And then ironically, that helped us land institutional business. And so institutional business is defined as any company or REIT or fund or whatever that owns more than 1,000 properties.
So that's the 1,000 is the definition?
That's the cutoff. Large investors, as they call it, are people that own between 100 and 999.
Okay.
That's still to you and I, like if somebody owns 700 houses, like that's a heavy hitter, obviously, but quote unquote, that's large. And then you go down the food chain.
There's always someone bigger.
There's always somebody bigger, making more money, bigger yacht, the whole thing. But so what we did is I kind of blended that. I still love finance and still manage your own money and do all that stuff. But we were able to luckily get on with 2 major hedge funds in 2021 and 2022. And obviously rates were so cheap. They were buying everything that they could. And even Denver, being a more expensive market than a lot of the country, they saw it as a nice blend of still reasonable prices, pretty high rent, but not California or New York City type of acquisition prices. So we did a lot of business with like three agents, we did almost 300 purchases for one of our clients in about a 20-month period from 21 until the middle of 22. And then the brakes literally and physically like came to a screeching halt. I remember it yesterday. Ironically, I was in this building and we had the client kick the can down the road for a while, and then they walked away from 17 deals on June 17th. And they walked away from like $100,000 of earnest money. They're like, okay, we're done.
What year is this?
This is 2022, right before things started to go up for rates. So obviously they knew what was going on and we didn't. Helped our other business, which was a nice thing. Then we didn't have a lot of hedge fund business for about the next 18 months. And then with rates being where they are and a lot of consolidation is happening, we've now started over the last year, and we're working with 2 new funds that are active in Metro Denver and Colorado Springs, and they're selling properties.
So this is all disposing,
So
right?
this is all the dispo side. And so what they're doing is they are, I think, probably better capitalized, very strategic. They're buying other portfolios across the country, and then we're helping them and saying, hey, out of your list of portfolio properties, you should look at selling these ones because this one's beat up and you're going to have to invest CapEx. This one's maxed out on rent. You're probably not going to make much more money. So we're helping them sell.
They're doing asset management on there too.
Yeah, we're helping them with asset management, being local investors. I think that's where again, has been my passion. Like, yeah, we're great real estate agents and we have a badass team, but I think of it as an investor first. Like, commission will come. We don't care about that. And so they're probably selling off roughly 10 to 12% of their current assets that were just, again, funky houses, trashed houses, a couple of outlying properties. Like they bought one fund bought out another, and they had a handful of deals in Pueblo. They don't want anything in Pueblo. So we're selling all these things for them.
So they're selling front range and buying portfolios in other geographic markets?
Yes,
okay,
exactly. Like they're
what's their approximate unit count or house count around Denver, the front range?
This one only has several hundred in Metro Denver.
Only.
And I say only because our other client had several thousand in the area. And so for them, that's perceived as small. And it's funny because we want to be obviously an industry partner, but they're not giving us like the exact numbers. But a couple hundred properties.
And they're selling about
Denver.
10 or 15% of those?
10 or 15%. So I know people are like, oh, the hedge funds, they're going to tank the market. They couldn't tank the market if they needed to, because think about it. We've got, let's call it 11,000 single family homes for sale. And if they sell 70 in a month, that would be a ton for them. Like that's not going to move that's not going to move the
I saw some JLL study, and they only have like 3 to 5% of total market share anyway. Like it's, I might be off by a point or two, but it's pretty minimal. Like they're not moving the market one way or the other.
No, you're not. And it's funny, I had another episode that I recorded because people kept hammering me on that. And I was like, all right, fine, let's just get to the data. And you're right, depending upon like the market, the cycle, the study or whatever, it's 2 to 4% that, again, people that own 1,000 or more homes actually own. The bigger chunk is actually when you go all the way down to the mom and pop investor, which technically we would probably classify as.
Yeah, that's the vast majority.
Under 100. Yeah, they own 20%.
Yeah.
People aren't going to liquidate that all at once because that's where their wealth is, that's where their tax deferment is and all that stuff. So I don't see it cratering because of like mass sell-off or whatever. Like I don't see it. Again, data, not just like gut feel.
Okay, so you're starting to, when did these dispositions pick up for you on the institutional side?
Yeah, so we did 38 sales in 2024. And then we're now in the process of selling off another 30 or 40 homes in 2025 for one particular client. We're out there trying to pound the pavement. So if anybody's listening, we're good at it. We can do it in other markets. But yeah, so not crazy numbers. So when it was the buy side, it was one particular person buying about 300 in roughly 20 months. And now we'll probably in a 2-year period sell off between 70 and 80 of their properties on the sales side. I'm obviously trying to be ahead of the curve and dying to see like where's the interest rate inflection point where maybe they start buying, or again, we want to be there for strategic sales.
Do you think they'll start buying in Denver again, or is like, I mean, the Denver numbers are tough. The Denver market, appreciation has popped. Do you think they'd come back strong in Denver, especially with like the legislation the last couple of years?
I think
do you see them coming back?
Yeah, that's a good point. I think they only would if they could get screaming deals. So when we're talking to people, it's interesting. I just had one person that I found that's representing a fund there in Florida. They're looking at Denver. They had a really good buy box, which is the definition of what they want to purchase. Very succinct, great guidelines, good addresses, but they said we only want to buy off market. So I think their thought
Was
process
it realistic though? Like their numbers and everything?
they were actually fairly realistic.
Okay.
Like a little aggressive. Like we got to get a really good deal for them, but it wasn't like
Wasn't the unicorn?
It wasn't the unicorn.
Okay.
Exactly. So so they're again strategic purchases. And at what point does that come back? I don't think it will ever come back to like the good old days of pre 2021 where money was dirt cheap and people just had money to spend. I don't think that's coming back, at least in Denver. I
mean, I don't know if you have any. This is totally off topic. Just read on like institutional buying. One of the opportunities I've seen, I've heard some whispers around this. There's obviously a lot of pain in new build communities.
Yes,
and I think I'm curious if there's institutional appetite for like new build community. Hey, these were build to sell. These 10, 20, 40, 50 unit townhomes, houses, whatever. And those, I mean, builders have a lot of pain right now.
Yes.
And then there's more skill. Hey, you're buying one area, easier to manage. It's new, lesser capex. Just easier operations all around. Have you heard, or do you think institutions might come in to swoop in and buy some of these like distressed, smallish, medium-sized new build communities?
Absolutely, they are, and our client is actually looking for that. They have a kind of different division. They call it their scattered site division for looking exactly that. So we've said, hey, here's a 13 home package that you might want to look at. Here's 51 home package, and it's carving off pieces of medium-sized builders that might have that pain, or even people that just want to kind of mitigate their risk. Yes, they are absolutely looking for those, and I think that's probably a lot bigger upside and more volume than the independent one-by-one accumulation on existing single-family homes.
Okay, cool. That's interesting to hear. I like that play. I think buy that, hold on for 2 or 3 years, cash flow, and
yes,
I think the market will come back.
Yeah.
You know.
I think so too. Again, just looking at data, I feel like we've now hit the third year of the lowest volume of transactions in the last 30 years. Again, I'm not smart enough to call whether it was last year, obviously not this year, next year, who the hell knows. But we got to be in the bottom-ish of the trough of volume. And I had somebody, interestingly enough, ask me the other day, they're like, oh my God, you were doing stuff in 08, 9, and 10. Again, I was lucky because I was the buyer. I wasn't a person losing my house. But there was still more transactional volume back then because there was investors buying. Now it's just
people had to sell too.
And good point, they had to sell. We're in this
or the
weird
banks had to sell.
Stalemate. Or you're right. Or the bank says you're selling, or the bank's selling. So we're in this weird stalemate. So I don't know. Again, I'm not being like crazy bullish. Like, when it hits a certain rate, things are going to go crazy. I just think they'll slowly get back to being mildly healthy, and we should be able to win in that business anyways. So.
All right, last question here, so that you can polish off your crystal ball.
Okay.
We are recording this early Q4 2025. Do you think overall Metro Denver prices in 2026 higher, the same, or lower than 25?
Ooh, that's a good one. And
I've debated this a lot, so I'm really curious here.
I'm pausing. Yeah. So my quick gut is I think it will be in 26. I think it will be flat. But I'm going to call it a false flat because of exactly what I mentioned earlier in the episode of our property. Like we were talking about this with my staff and then another couple of investor groups. There's something going, I shouldn't say something. It doesn't, the concessions that you have to give, whether it's a rate buy down or whether it's whatever else, they're significant. And that data isn't really showing appropriately. So if you could find a way to get to the bottom of that, that's probably a really great exercise. If you could recognize that number, I think it would actually be down. But I think just the classic simple data that is being reported is it will be flat. I don't think it'll be up. I don't think it'll be down. But the reality is it's probably down a couple points. We're probably down 2 or 3%. And that's kind of how we're underwriting deals. That simple math. If I'm going to sell a house that I see a bunch of houses selling at 725, I'm going to price it at 700. And forecast that's going to be it. So not a monster haircut, but that's kind of what we're doing. So
I'm in the same boat as you. I think we'll be I thought the whole time we'll be flat. Now year over year, I think we'll be real numbers down a couple points. And I think that will be best guess, probably bottom-ish for real, but we'll see in a couple of years how it works out.
Totally. Who knows?
Derek, love having you back on.
Thanks,
this
Chris.
was fun to chat. We'll have to get back into a better rhythm on here.
Yeah.
But thank you. And if people want to learn more, it's elevationinvest.com.
Yeah, so website is elevationinvest.com, or they can find us on any of our socials, and it's Elevation Invest, Facebook, Instagram, Derek Marlin on LinkedIn. But company website is elevationinvest.com.
Awesome. Derek, thank you so much.
Thanks, Chris. Appreciate it.